So picture this. You're at a friend's house chilling on the couch and someone randomly drops, "Bro, should I buy Tesla stock now or wait till the next dip?" And while you pretend to understand what's going on, you're internally spiraling. Wait, what's a stock again? Is that like adult monopoly or something? Relax, you're not alone. Most of us were just as confused when we started, and some people spend their whole lives nodding at CNBC like they understand, while their savings account cries softly in the background. But here's the thing. Understanding the stock market doesn't require a finance degree or an IQ that sounds like a Wi-Fi password. In fact, by the end of this story, you'll know more than 90% of people your age, and your bank account will be like, finally, someone around here has a plan. Let's start simple, like third grade simple. Imagine your favorite pizza place. Let's call it Slice Empire. They make the best pepperoni in town. Their garlic crust is illegal in 5 states for being too good, and business is booming. Now the owner, let's say her name is Gina, wants to open 5 new locations. But she doesn't have the money. So what does she do? Rob a bank? Nah. Instead, she decides to sell little pieces of her business, called stocks, to people like you. When you buy a stock in Slice Empire, you now own a tiny chunk of the company. Like you're technically a boss now. Congratulations. You're not just eating pizza, you're investing in it. That's what stocks are. Tiny pieces of ownership in companies. Not magic, not gambling, just ownership. Now you're probably thinking, okay, but how do I make money with this stuff? Great question. Let's say you bought a stock of Slice Empire for $10. The business takes off, opens 5 more stores, and now that same share is worth $20. If you sell it, you just made $10. That's called a capital gain. Basically, buy low, sell high. Just like people do with sneakers, Pokemon cards, and iPhones they bought on sale and resold to someone in a panic. But there's another way to make money too. And this one's even more chill. It's called dividends. Some companies are so profitable they're like, "Hey investor, thanks for believing in us. Here's a few bucks every few months just because." You literally get paid for owning something. It's like if your AirPods sent you money every time you use them. Weird, right? But awesome. Now I know what you're thinking. This still sounds risky. Isn't the stock market just legalized gambling in a suit? A lot of people think that. And if you're buying stocks based on what your favorite TikTok guy says while standing next to a rented Lambo, then yeah, you are gambling. But if you take the time to understand what you're investing in and you focus on the long term, it's actually one of the safest and smartest ways to build wealth. Here's a stat to blow your mind. Over the last 100 years, the U.S. stock market has given average returns of about 6.5% to 7% per year after inflation. That's not a maybe. That's a historical fact. So, if you had invested $1,000 in the S&P 500, which is basically a giant basket of 500 of America's biggest companies, back in 1993, today, you'd have more than $10,000. That's the power of long-term investing. No lottery tickets, no crypto coin of the week, just steady growth. Let me tell you a quick story. There were 2 friends, Danny and Sarah, both 22, both working at the same coffee shop. Danny spent most of his paycheck on vape pens, late-night Taco Bell, and those $7 coffees he technically makes at work but still buys on his day off for the vibes. He thinks investing is too complicated and says stuff like, "I'll start when I make more money." Meanwhile, Sarah decides to invest just $100 a month into a basic index fund. We'll talk about those in a second. She doesn't know everything, but she knows the earlier she starts, the better. Fast forward 10 years. Danny's 32, still broke, still talking about that one time he almost bought Amazon stock. Sarah? She has over $20,000 saved and invested, all while working the same job. That's not magic. That's consistency and compounding. It's not about how much you invest. It's about when you start and how often you do it. So how do you actually begin? First, you'll need a brokerage account. Think of it like your stock wallet. There are apps that make this super easy. Robinhood, if you like a slick interface, but be careful not to treat it like a casino. Fidelity, if you want solid tools. Or Charles Schwab if you feel like sounding fancy. Once you're set up, you don't need thousands of dollars. You can start with $10. Seriously. Many apps let you buy fractional shares, which means you can own a piece of Apple even if you can't afford a full $200 share. It's like buying a slice of pizza. Still delicious, just more affordable. Now, unless you plan on researching individual companies and reading financial statements like bedtime stories, your best move is probably to start with index funds. They're the lazy genius way to invest. An index fund is like a basket of stocks. So instead of trying to pick one winner, you get a little bit of everything. Think of it like getting the sample platter instead of just the mozzarella sticks. The most popular one? The SP 500. It includes companies like Apple, Google, Amazon, and 497 other giants you probably use every day without thinking. And even Warren Buffett, yeah, that old billionaire guy, says most people should just invest in an SP 500 index fund and chill. One of the biggest mistakes beginners make is trying to time the market. You know, waiting for the perfect moment. But guess what? No one can predict the perfect time, not even the experts. So stop trying to be psychic. The best approach? Just invest consistently. Set up an automatic deposit each month. Rain or shine, crash or boom. Treat it like a Netflix subscription for your future self, except instead of binging shows, you're building wealth. But what if the market crashes? Oh, sweet summer child, it will. The market always crashes, and it always comes back. In 2008, during the financial crisis, the market dropped 50%. Ouch! But by 2013, it was fully recovered, and by 2020, it had doubled from pre-crash levels. The key is to not panic. Zoom out, think long-term. Imagine the stock market like a yo-yo going up and down, but on an escalator that's always rising. So what have we learned? That you don't need to be rich to start investing. You just need to start. That investing in stocks isn't some Wall Street mystery. It's owning pieces of the companies you already use. So go open that account. Invest something, anything. Keep learning, and let your money start working harder than you do. Oh, and share this with your friend who still thinks the stock market is a scam, but drops $200 on sneakers every 2 weeks. They need it. And now that you've taken your first step toward financial freedom, let's go even deeper. Because here's the truth. It's not just about how much money you have. It's about how you think about money. Click on this video, Broke versus Poor, Why Mindset is Everything, and find out why the way you see your situation might be the very thing keeping you stuck. Trust me, this one's a game changer.